If you have less than $25,000 in your trading account, you're dealing with the PDT rule, limited buying power, and the pressure of knowing that one bad trade can set you back weeks. But having a small account doesn't mean you can't make money in options. Ramsey, Tito, and myself all started with accounts lower than 25K, and we used 3 different strategies to grow them past that 25K mark. Before I show you these 3 strategies, let me explain something that every small account trader needs to understand, because this changes how you're going to approach trading with under 25K. Let's get into it. Okay, so if you're not familiar with the pattern day trader rule, or known as the PDT rule, this is what it is. It basically states that any margin account under $25,000 can only day trade 3 times in a rolling 5-day period. A day trade is defined as the opening and closing of the same position within the same day. If you hold a position overnight, it does not count as a day trade. It's a completely different thing. So for example, let's say you take a day trade on Monday, no trades on Tuesday, and then you take a day trade on Wednesday and Thursday. On Friday, your broker is going to say, hey, we have flagged you as a pattern day trader. What would happen next is they'll either restrict your account for 90 days, which you can appeal, and then maybe they unrestrict your account, but it'll just repeat itself once you day trade again. Or they're going to ask you to deposit enough cash to get your account back over 25,000, which for a lot of us, it's completely unrealistic. A lot of us are starting with 5K, 10K, getting it up to 25K is just not realistic. And I should say, this is a FINRA rule. This is not a broker rule. So it applies to every single broker within the United States. So now that we understand what the PDT rule is, here's something that a lot of people don't actually realize. You don't have to trade on a margin account. That just typically is the most normal route people take. But what you can do is either open or convert your current account to a cash account. And the PDT rule does not apply to a cash account. The reason for that is because in a cash account, you're only using settled cash when you trade. It's kind of like using a bank account versus a credit card, right? You don't have to borrow anything to trade. You have the money in your account and therefore you can use it how you want it. Now, of course, there are some trade-offs when going to a cash account. In a cash account, your trades need to settle before you can reuse that capital. Luckily for options traders, options settle in what's called a T+1 settlement period. What that means is essentially if you close an option trade on a Monday, the next day, Tuesday, you will have that cash settled for you ready to trade again, which is really great for small accounts. That means you can day trade all day long, go home with your full account in cash, and then the next day you can day trade it all over again. And of course, you can buy and sell naked options. However, because you're not trading a margin account, you can't trade strategies that require margin. And I'll talk about those strategies because they're part of our 3 strategies that we used. So a cash account, again, PDT doesn't apply and it's the best for buying options. With a margin account, you of course have the 3-day trades on a 5-day rolling basis. Otherwise, you'll be flagged as a PDT trader, but you do get instant buying power and you can also do some of the more complicated strategies within options, which include vertical spreads, which I'll talk about in a moment here. So here's the hack that you could use. If you go through this video and you're like, hey, I like all 3 strategies that you presented, you can open up a cash account and a margin account. So let's say you have 10 grand to work with, you can put 5 grand in a cash account so that you can day trade options, and you can put 5K in a margin account so you can swing trade or trade different types of spreads. That's the pro hack, and I think that's actually the best way to approach options. Okay, so now that I got the PDT rule out of the way and the difference between a cash and a margin account, we can start talking about the 3 option strategies that helped me grow my account as well as my 2 partners, Ramsey and Tito. I should say all 3 of these strategies are defined risk strategies, meaning that if you lose on one of these trades, you are not going to be in a detrimental loss. You understand exactly how much you're going to lose before you enter the trade, which is a very key thing to do when you're a small account trader, because once you lose too much on margin, for example, you're wiped out and you can't trade anymore. All right, let's get into the option strategies. Okay, let's get into the first option using a real trade that we actually took on Tesla. So this is a daily chart of Tesla. It's been in this pretty big range, and just recently on March 9th, it kind of tested the bottom of the range here near 380, 385, and it held. And so we thought that was pretty bullish. So the next day we came in and we actually bought some calls for short-term swing trade. So I'm going to zoom in on the 15-minute chart here so you can see it a little bit clearer. So here's the March 9th day, right? Had a really strong move lower and then got bought up pretty strong. And then on the next day on the open, we gapped up and we held the gap up and it showed a lot of strength, right? So we ended up buying calls within the first 15 minutes of the session on March 10th. And let me show you exactly which calls we ended up buying. So this is the March 20th 410 call. You can see here on March 10th, 6 a.m. The calls are worth about $8.50 when we opened them. And they ran all the way to 15.5 or so, about 2x. So that's if you bought naked calls, right? This is the simplest strategy in options, right? It's just buy or sell calls or puts, right? That's it. I should say buy and close calls or puts, right? Naked calls and puts. That's the simplest option strategy ever. And if you master how to trade directionally, you can master these other strategies and use them to your benefit. So simple trade, buy an option at 8, sell it at 15. Obviously, not going to do it perfect, but maybe you buy it at 8, sell it at 10. So that's really strategy number one. And the problem with this and what the next strategy will actually help you accomplish is an option like this is 850 bucks. If you have a $5,000 account, you might not want to risk that much. That might be too risky for your account. So let's talk a little bit about position sizing, because this will actually help you decide how you want to trade options in the future. In general, we would not risk more than 5 to 10% of your account on a single trade. Above 10%, you start to enter the window of, hey, if I lose like 3-4 trades in a row, I'm down 40% on the account. And you never want to be in that position. 5 to 10% is actually, I would say, less conservative than most accounts. A lot of folks, master traders, they'll only do 1 to 2% of their account, because losing 2% on a large account is actually quite a bit. But when you have a small account, you have to work with what you've got, and 5 to 10% is an appropriate value if you're looking to aggressively grow your small account. So what does that mean for different account sizes? On a $5,000 account, you don't want to risk more than 500 bucks on any given trade. So that Tesla trade I just showed, that was 850. You can't even buy one contract. Even at a $10,000 account, your max risk should be 1,000. 850 might be too much. Maybe you don't have the conviction to put in 850 and you really want to cap it at 500 bucks. Same thing goes for 15 and 20K accounts. So here's just an example trade. Let's say you buy an option at 250, it's $250 worth of risk, and you exit at 4. You make a total profit of about 150, which is a 3% account gain. That's how naked calls and naked puts work. Very straightforward. The thing with naked calls and puts is these trades have to be directional. If the market goes sideways, your calls and puts can lose value just due to the passage of time, and that can be a big detriment for small account traders. So this strategy works great if you're more of a day trader and the market is providing a lot of momentum and directional moves. If the market's moving sideways, this kind of strategy will not work very well. If you want to see us apply these strategies every day and get the trades before we actually enter them, consider joining our community. Links in the description. All right, on to the next two strategies. So let's go back to Tesla. I mentioned that you could have traded naked calls on this setup, right? Gap up, hold the gap up, buy calls, and then sell on the next day. A one-day swing trade that paid 2x. The other strategy you could have taken, which is what we actually did, we bought a debit spread, which is a vertical option strategy where you buy a call or put and you sell a further out of the money option, call or put. They have to expire on the same day, or they have to have the same expiration. And what that allows you, it actually brings your cost basis down, but it also caps your upside. So if you're expecting a very big directional move, then it's better to go naked call or naked put. However, if you're not totally confident in the move happening right away, it might actually be better to buy a debit spread that caps your upside. However, it also allows you to hold an option with less drawdown than a naked call. So let's just talk about the Tesla trade we took. So instead of just buying the 410 call right around $8.50 and then selling it the next day near 14.15, what we did, we bought the 410 call and then simultaneously we sold the 420 call. So let me show you what this looks like on the actual option chain. So here's March 20th. Here's the 410 call. Let's say I'm not buying it today, but let's say you were buying it today. The 410 call is $460 per contract. If you go in and you sell the 420, you reduce that entire 4.6, you reduce it by 2.3, and you get a total of 2.25. So for this strategy, instead of buying the 410 call naked at $460, you can buy this call debit spread at $225. And what this opens up is basically if you have a small account and you're not willing to risk $800, you might risk what we did, which was $360 at the time. And so I mentioned this caps your upside. So basically the upside on this trade, it's the width of the entire debit spread. So 420 minus 410, it's $10. And if you buy it at 3.6 like we did, our max was 10. So 3.6 to 10, basically a 2-to-1 type risk reward. And that's the trade we took. So, when we bought it this day on this candle open, we bought it at 3.6 and then we sold it at 5.4 for about a 50% gain. The nice thing is when Tesla was chopping around after we entered it and kind of went lower, we didn't see much of a drawdown on this move. Whereas if you were buying the naked call, which I'll show you again, let's say you bought it 8.5, you actually ended up seeing a decent drawdown down to under $7 or so, which that kind of move could shake you out. When you're down $150, $170 on a $850 position, you might not want to swing it overnight. But with the debit spread, our drawdown was limited because the move in theta doesn't go against you the way it does on a naked call. Okay, let's talk about why you might use the debit spread in a more visual manner rather than looking at the exact trade we took. So let's say you want to buy, you're bullish on the S&P and you want to put a directional bet for the upside. So strategy one is you buy a naked call. Let's say you buy the SPY 590 call for 2.5. Your max loss is 250 bucks. Your max gain is in theory unlimited. News comes out and S&P goes up 10%. You're going to make a lot of money. And on this particular trade at a 5K account, this would be 5% risk. So that's the naked call strategy. If instead you're thinking, okay, maybe I'm bullish on SPY, but are we going to rip today, tomorrow, in a week? I'm not exactly sure. In that scenario, I would take a debit spread, which in this scenario would be a 590, 595 call spread. That's a 5-point spread that costs you $1.20. Your max gain can be 380. So you are capped, right? But you have a lower cost of entry and you could potentially risk less, right? This option was 250 for just one contract. If you did not want to risk 250 bucks, you can consider a call spread for 120 bucks and risk only 2.5% versus 5% of your risk. So that's really the benefit of using a debit spread rather than just doing naked calls. Okay, so let's talk about the third strategy, which is a credit spread. Go back to Tesla. So Tesla, right? I mentioned we bought debit spreads here. You could, in theory, let's say you were bearish Tesla on this day instead of bullish like we were, you can take the opposite trade, which instead of buying the 410 call and selling the 420 call, let's go back over here and let me show you that. So instead of buying the 410 call and selling the 420 call, you can actually reverse this. I can sell the 410 call and buy the 420 call, and that is a credit spread. So a credit spread is when you sell an option and you buy a cheaper out of the money option. So it's the exact opposite of a debit spread. In a debit spread, you pay for the option. In a credit spread, you receive a credit, and that's the difference between a debit and a credit spread, but they are very similar. So in this exact scenario, this is what's called a bear credit spread, meaning you are anticipating Tesla to go lower or sideways, which is a big key. What a credit spread allows you to do is you can actually bet on a stock going sideways and you can make money off that. That's something that you cannot do with a debit spread, and especially you cannot do with naked calls or puts. And this is something that I think anyone involved in trading options should know how to execute because it is very important, and it's specifically very important during this year where the market is literally going nowhere. Credit spreads are probably the best trade in the market right now. So let's say instead of on Tesla, let's say you were bearish here on the pop and you're trying to fade it. Instead of taking naked puts, because maybe you're thinking, I don't know if Tesla's going to go down lower today or tomorrow or the next day. What you could do instead is actually sell an option and buy a further out of the money option for cheaper, resulting in a credit spread. So let's say you sold the 410 call and bought the 420 call and you received a net credit of 3.6. What that allows you to do is collect premium as long as Tesla closes under your strike price, which in this scenario was 410. As long as Tesla closes under that level, you collect all the premium by expiration. So in this scenario, Tesla popped to 410, rejected. If you took puts here, you would be wiped out on this move. There's like no way you would have probably held your puts. You would have stopped out and that was the end of that trade. If instead you took a call credit spread, you might see, okay, Tesla got through 410, but it's starting to reject here. I'm not down that much. My break even is 3.6 off 410, which is 413.6, right? That's your break even. And this move here is not that detrimental to your trade. Come the next day, you're in profit because now Tesla's under 400, under where you sold it. And the key thing is 2 days have passed. With a credit spread, theta is in your favor. Every day that passes is your options losing value and paying you. Time is literally paying you. You're trading like a market maker at this point. And so this is a really good strategy to have, especially if you're trying to gain just a little bit of money while the market is trading. Maybe you don't have a directional trade in mind, but you're looking to still grow your account slowly. Okay, so I'm gonna walk through a credit spread that I sold that I would say that was actually really bad timing, but I still came out with a profit because the nature of the credit spread. So this is SPX 15-minute chart. So on this day, on March 9th, market gap down. If you were trading, there was some news on Iran over the weekend, market gap down pretty heavy, sold off pretty strong, and then started this bounce. And I saw this a rejection candle up here near 6,700. It was a big key level for me to watch, and I was looking for a rejection here. So I thought the market could actually reject and head back lower, but I didn't want to buy puts because puts were already super expensive on the day. IV was expanded, and it didn't make sense to me to just buy puts, even put debit spreads. So what I ended up doing was I took call credit credit spreads, meaning I sold a call and then I bought a further out of the money call. And these were 0 days to expiration, so they were expiring the same day. So the exact trade I took, I took a 1 day to expiration trade. So it was expiring the next day. So the exact trade I took, like literally right here on this candle, was I sold the March 10th 6,700 call. So this was at the money call. And then I bought the 640 call, which is right up here. So what that means is if SPX closed over 6740 the next day, I would lose the entire premium. However, if it closed under 6700, I would be credited the entire premium. So I sold these for 20. This was a basically 50-50 shot. If the trade worked for me, I would make $2,000. If the trade worked completely against me, I would lose $2,000. So 1-to-1 risk reward. What ended up happening, the trade went completely against me and SPX ripped 40 points. And up here, I thought this is probably going to be a losing trade, but let me just at least give it the day. The expiration's tomorrow. And what ended up happening was up here, I believe the option was worth 26. So I was down $600 on 2000. And SPX ended up coming lower and it just kind of poked underneath where I originally sold them. Over here, I decided to take the position off because of the timing was off and SPX had already dropped 40 points. I was like, okay, that's a pretty decent reversal already. There's a chance that the buyers step in. And so what I ended up doing was I sold them at 18, or I should say I bought them back at 18. So 20 to 18, that's $200, 10%, $200 on $2,000 is a 10% gain. But let's say I bought puts here. There's no way these puts would be worth more here than they would here. Trust me, especially 1 day to expiration. They would probably be down like 15, 20% at the same price level because of this passage of time. However, if you take a call credit spread, it will be worth the same, if not less, right? Because it's tracking the price better. That doesn't make sense. But with a call credit spread, you don't lose the value because it's directly correlated with the price. So as long as you're under 6,700, that credit spread is going to 0. And since you sold them, you gain that money. Okay, so that's an example of a credit spread that I took that literally flopped, but I still made money on. Okay, so let's talk about when do you use each of these 3 strategies. The first thing you want to figure out is what is the market doing, right? That's where you start. What is the market doing? Are we trending or are we choppy? If we're trending, you want to take more directional plays. You want to benefit from a market that's trending. And therefore, you want to take either naked calls or puts or debit spreads. And the difference between the two is there's a couple things to consider. One, are the options too expensive for my account? Okay, if so, let me take a debit spread to reduce my cost basis. Is implied volatility low? Okay, I want to take long calls or puts because the options are actually really cheap. And then the other thing to consider is, do I expect the move to happen quick or do I expect the move to happen slow? If quick, you want to be in naked calls or puts. If slow, you want to be in debit spreads so that you don't get chopped up in the move. So let's say the market is chopping or range bound. There's no clear direction. You can still make money. That's where credit spreads come in. Let's say you're coming into a support or resistance level. Do some credit spreads and let time work for you. You will gain premium as long as the market is going sideways and not against you, just through the passage of time. Okay, and last thing here, here's a little cheat sheet for you. You can screenshot this. This will be helpful just to have on your desktop or whatever. But here's the main sort of differences and what type of account you need for each of these strategies. So to recap, long calls or puts, that's strategy number 1. When you use it, market is trending. You have conviction. You believe the market is going to go higher or lower, and you think it's going to go fast. That's when you want to be in naked calls or puts. In general, you don't want to be risking more than 5 to 10% of your account per trade, but the capital you put up for each option is exactly how much you're going to lose if it goes to 0. The account type that you want to be in to trade this kind of strategy is a cash account because you can day trade as many times as you want as long as you have cash settled. Okay, next strategy, debit spreads. When do you want to use this? Implied volatility is too high, options are too expensive, or you have a price target, you just don't know how long it's going to take to get there. What do you get in a benefit is it's always a fraction of the naked option cost. However, the downfall is if you get a very, very strong directional move, your total profit is capped by the out of the money strike that you sold. You need a margin account to trade this. Okay, last strategy, credit spreads. It's the opposite of a debit spread. You want to use these when the market is choppy or range bound and let theta work for you rather than against you. Your risk is always the width of the spread minus the credit that you receive, and you need a margin account to do this vertical spread. All right, those are the 3 strategies that work for small accounts under 25K. You don't need a massive account to make money with options. You just need strategies that fit your capital and the discipline to execute them properly. Everything I walked through in this video is something you can start using this week. Pick one, practice it, get comfortable with it, and then try the others as you go along. And lastly, if you want to trade with me, Remzi, Tito, and see how we apply these strategies every single day, the link to our community is in the description. And if this helped you, subscribe, because I'm going to be putting content out there for traders that are trying to grow their account from the ground up. I will see you in the next one.